If you're a senior homeowner in British Columbia and you've been deferring your property taxes to protect your retirement income, there is a change happening right now that could cost you thousands of dollars more over the years ahead, and a lot of people still don't fully understand it. The province has quietly rewritten the interest rules on the property tax deferment program, the same program tens of thousands of BC seniors rely on to stay in their homes. And if you're enrolled in automatic renewal, this change may already be applying to you, whether you noticed it or not. This isn't a rumor, and it isn't speculation. This is a real, confirmed change that came out of British Columbia's 2026 provincial budget, and it directly affects how much interest builds up on the property taxes you choose to defer. For decades, this program worked one way. Now going forward, it works very differently, and the difference between the old system and the new one is not small. We're talking about a shift from simple interest to compound interest, and a jump in the rate itself. If you own a home in BC and you're 55 or older, or you're a surviving spouse, a person with a disability, or a parent supporting children, this is something you need to understand clearly, because the wrong assumption here could quietly cost your estate a significant amount of money down the road. In this video, we're going to walk through exactly what changed, why the province made this decision, who is protected under the old rules and who isn't, what the real risks and remaining benefits look like, the important dates and requirements you need to know, the mistakes seniors are making right now with this program, and the practical steps you can take today to make sure you're making an informed decision, not an accidental one. By the end of this video, you'll understand this program better than most homeowners who are actually enrolled in it. Before we get into the details, if you find value in straightforward, honest breakdowns of the programs and benefits that affect Canadian seniors, things like CPP, OAS, GIS, and provincial programs like this one, go ahead and subscribe and turn on notifications. New updates on senior finances and government benefits come out regularly, and you don't want to miss the ones that could affect your household budget. Now let's get into what this program actually is, because before we talk about what changed, it's worth making sure everyone watching understands the foundation. British Columbia's property tax deferment program has been around since 1974, created under the Real Property Tax Deferment Act. The idea behind it was simple, and frankly quite compassionate. As property values rose across the province over the decades, many long-time homeowners, particularly seniors living on fixed incomes, found themselves in a difficult position. Their homes had grown enormously in value on paper, but their actual cash income hadn't grown at all. They were, as the saying goes, house rich and cash poor. Rising property values meant rising property tax bills, and for someone living on CPP, OAS, GIS, or a modest pension, that rising tax bill could become genuinely difficult to manage every single year. The property tax deferment program was designed to solve exactly that problem. It allows eligible homeowners to defer or postpone payment of their annual property taxes. Instead of paying the municipality directly, the province of British Columbia pays the property taxes on the homeowner's behalf. That deferred amount then becomes a loan, secured against the property through a lien registered on the title. The homeowner doesn't have to repay that loan immediately. In most cases, it gets repaid when the home is eventually sold or transferred, often as part of an estate settlement. There are two main streams under this program. The regular program is available to homeowners who are 55 years of age or older, surviving spouses of any age, and people with disabilities. Then there's the Families with Children program, designed for parents, step-parents, or anyone financially supporting a child, which has slightly different equity requirements, which we'll get into shortly. For 50 years, this program has served one core purpose, helping people stay in their homes without being forced into financial hardship by rising taxes. And for most of that time, one of the biggest appeals of the program was that the interest charged on deferred amounts was kept deliberately low, well below typical borrowing costs, because the goal was support, not profit for the province. That's the piece that has now changed, and it's a bigger change than a lot of people realize. So here's exactly what happened. In British Columbia's 2026 provincial budget, the government announced a significant overhaul of the interest structure on the property tax deferment program. This wasn't a minor adjustment. It was a fundamental change to how interest accumulates on deferred taxes. Under the old system, interest on deferred property taxes was calculated as simple interest, set at a rate 2 percentage points below the Bank of Canada-linked prime lending rate. Simple interest means the interest is calculated only on the original amount deferred. It doesn't compound, it doesn't grow on top of itself. That kept the long-term cost of deferring taxes relatively modest, even for homeowners who deferred for many years in a row. Under the new system, which applies to taxes deferred starting with the 2026 tax year, the rate shifts to prime plus 2 percentage points, and, this is the key part, it now compounds monthly. That means interest is calculated not just on your original deferred tax amount, but also on the interest that has already accumulated. Each month, on a set day, any interest that built up gets added to your balance, and then next month, you're charged interest on that new, larger balance too. Over a period of years, compounding interest grows meaningfully faster than simple interest, even at a similar headline rate. To put this in real terms, using publicly reported figures from earlier this year, with the prime rate sitting at roughly 4.45%, the old formula, prime minus 2%, worked out to an effective simple interest rate of around 2.45%. Under the new formula, prime plus 2% compounded monthly, works out to an effective rate of somewhere around 6.45%. And because it compounds, the real cost over time is even higher than that simple percentage comparison suggests. There's another important detail many seniors overlook here. This change does not apply retroactively. If you already have property taxes deferred from 2025 or earlier years, that existing balance remains under the old rules, the old simple interest rate. The new higher compounding rate only applies to taxes you defer starting with the 2026 tax year and onward. So there's a real line being drawn here between what you owed before and what you choose to defer going forward. The provincial government's stated reason for this change centers on fairness. British Columbia's finance minister explained in the legislature that because the old interest rate was so low compared to typical borrowing costs, some homeowners who genuinely didn't need financial assistance were still using the program, deferring their taxes and investing that freed up cash elsewhere for a better return, essentially treating the program like an extremely cheap loan rather than a safety net. The government's position is that the new rate discourages that kind of use while preserving the program for homeowners who truly need it. But that's only part of the story. Seniors advocacy groups have pushed back hard on this reasoning, and the numbers they're citing are worth knowing. According to Ministry of Housing statistics, 44% of program participants have household incomes under $70,000 a year. According to Ministry of Finance data published in May 2026, the median annual deferral amount is around $3,800, and roughly 80% of participants end up repaying their deferred balance within 10 years, typically because they sell their home. In other words, according to the government's own data, this program is overwhelmingly used by exactly the kind of modest income, house-rich, cash-poor homeowner it was originally designed to help, not primarily by wealthy investors treating it as a financial strategy. There's also a financial detail worth being transparent about. The BC Seniors Advocates Office and organizations like the Council of Senior Citizens Organizations of BC have pointed to government projections showing this interest rate change is expected to generate additional provincial revenue, reportedly around $11 million in the 2026 to 2027 fiscal year, growing to roughly $23 million the following year and around $34 million the year after that. Advocacy groups have argued this makes the change look less like a pure fairness measure and more like a revenue tool, a characterization the government has pushed back on. We're not going to tell which side of that debate is right. That's a policy argument playing out publicly between the province and seniors advocates, but you deserve to know both perspectives exist because they've both been stated on the public record. So who does this actually touch? Roughly 78,000 households across British Columbia currently participate in the property tax deferment program, according to figures reported this year. That's a meaningful number of homes, and it spans every region of the province, from Metro Vancouver to Vancouver Island to the interior and the north. If you are currently enrolled in the program and you have a balance that was deferred in 2025 or earlier, that specific balance is not affected by this change. It continues accruing interest under the old, lower, simple interest rules. That part of your situation stays exactly as it was. However, if you choose to defer your 2026 property taxes or any tax year going forward, that new deferral falls under the new interest structure, the higher rate, compounded monthly. And here's the detail that catches a lot of people off guard. If you were enrolled in automatic renewal, meaning your deferral rolls over year after year without you having to reapply manually, your 2026 taxes may have automatically been deferred under the new rate structure, unless you specifically opted out. The opt-out deadline for the 2026 tax year was June 1st, 2026. If you're watching this after that date and you didn't opt out, your 2026 deferral is very likely already sitting under the new compounding rate. That's not something to panic about, but it is something to understand clearly because it changes the math on how quickly that specific year's deferred amount will grow compared to your older balances. Going forward, this affects anyone considering deferring taxes for 2026 and beyond. Whether you're a longtime participant in the regular program, a newer applicant, a surviving spouse, a person with a disability, or a parent enrolled in the Families with Children program. It also indirectly affects your family and your estate because whatever balance remains unpaid when the home is eventually sold or transferred gets settled at that point, meaning the interest that accumulates now has a direct effect on what's left over for your estate or your heirs later. There's another important detail many seniors overlook. This is a provincial program, not a federal one. It has nothing to do with your CPP, your OAS, or your GIS payments, and it doesn't affect your eligibility for those federal benefits. But because the same population relies on both, seniors managing a fixed income, a change like this can compound with other financial pressures many retirees are already juggling. That's exactly why understanding it matters, even if it feels like just one more piece of paperwork in a system full of them. Section 4. Benefits, risks, or opportunities. Let's be balanced here, because this program still has real value even with the new rules. The property tax deferment program remains, according to the BC Seniors Advocates Office, a legitimate and often necessary tool for older homeowners facing affordability challenges. The average deferred amount in the 2024 to 2025 year was reported at around $5,400, a meaningful sum for someone on a fixed income, but manageable within a deferral structure. For a senior who needs help covering property taxes while also paying for medical travel, home care, or unexpected bills, deferring taxes, even at the new higher rate, can still be far more manageable than trying to come up with that lump sum out of pocket every year, or worse, being forced to consider selling a home they'd rather stay in. The core benefit hasn't changed. You still get to keep your home. You still avoid the immediate cash crunch of paying your full tax bill in one go. You still have the security of knowing the province, not a private lender, is administering the loan secured quietly against your property title, rather than through some other potentially higher cost borrowing option. But the risk profile has shifted, and it's worth being honest about that, because interest now compounds monthly instead of accruing simply. The cost of deferring taxes over a long stretch of years, say 10, 15, 20 years, grows meaningfully faster than it would have under the old rules. A homeowner who defers modestly every year for 2 decades could see their compounded balance grow considerably larger than it would have under the old simple interest system, purely because of how the math of compounding works over time. That's not a reason to avoid the program altogether, but it is a reason to actually think through the long-term math, rather than assuming deferral is a set-it-and-forget-it decision. There's another important detail many seniors overlook here: minimum equity requirements. To qualify for the regular program, you need to maintain at least 25% equity in your home, meaning all registered charges against the property, your mortgage, any lines of credit, plus the amount you want to defer can't exceed 75% of your home's assessed value. For the Families with Children program, that threshold is 15% equity, meaning charges plus deferral can't exceed 85% of assessed value. If your equity position is tight, especially if you still carry a mortgage or a line of credit, this program may become harder to qualify for over time, particularly if the deferred balance itself starts eating further into your equity through compounding interest. The opportunity here, if there is one, is really about intentional planning rather than automatic enrollment. Homeowners who treat this program as a deliberate financial tool, deferring what they genuinely need, keeping an eye on their equity position, and periodically reviewing whether continued deferral still makes sense given the new rate, are going to come out of this far better position than homeowners who simply let automatic renewal carry them along without a second thought. Let's get very specific here, because the details matter more than ever under the new structure. The new interest rate structure, prime plus 2%, compounded monthly, applies specifically to taxes deferred for the 2026 taxation year and every year going forward. Any balance deferred in 2025 or earlier stays under the old rate, prime minus 2%, simple interest, no compounding. The application window for deferring your current year's property taxes generally runs from May 1st through December 31st each year. It's recommended you apply as soon as you receive your property tax notice, and ideally before your property tax due date, to avoid any late payment penalties, which are set by legislation and cannot be waived, even if you're in the process of applying for deferment. For the 2026 tax year specifically, if you were enrolled in automatic renewal and wanted to avoid the new rate applying to that year's deferral, the deadline to opt out was June 1st, 2026. That deadline has now passed as of this recording. If you missed it, your 2026 taxes are very likely deferred under the new compounding structure already, but that doesn't mean you're locked into deferring under those terms every year going forward. Each year remains its own decision. Interest rates on the program are reportedly reviewed and set twice a year, so it's worth checking current figures directly with the province rather than assuming last year's numbers still apply, since prime rate movements will affect the exact percentage charged even within the new formula. To actually apply, defer, renew, or opt out, everything is done online through the eTax BC portal or by phone at 1-888-355-2700 for the property tax deferment program specifically. You'll need your jurisdiction and roll number, sometimes called a folio or account number, found on your property tax notice or your BC assessment notice. If your property has more than one registered owner, each owner needs to individually agree to the program's terms and conditions, so married couples or co-owners should both expect to complete that step separately. There's another important detail many seniors overlook. If you have a mortgage or a line of credit registered against your property, you're expected to contact your lender before applying for deferment to make sure enrolling in this program doesn't conflict with the terms of your existing loan. Some lenders have specific clauses about additional liens being registered against a property, so this is a step worth taking seriously rather than skipping. Let's talk about where seniors are most likely to trip up with this program, because a few small misunderstandings can add up to real money over time. The first mistake is assuming automatic renewal means nothing has changed. If you've had your deferral renew automatically year after year without giving it much thought, it's easy to assume that convenience means the terms are staying the same. As we've covered, they're not. If you didn't actively opt out before the deadline, your newest deferral is very likely sitting under the higher compounding rate right now. The second mistake is confusing your old deferred balance with your new one. Some homeowners assume the entire cumulative balance they owe, years of deferred taxes all added together, is suddenly being charged the new higher rate. That's not accurate. Your pre-2026 balance stays grandfathered under the old simple interest rate. Only new deferrals from 2026 onward get the new treatment. Mixing these up can lead to unnecessary panic, or on the flip side, an inaccurate sense of how much your overall debt load is actually growing. The third mistake is not understanding the real difference between simple and compound interest. It's easy to hear 2% higher and assume that's the whole story. But because the new rate also compounds monthly rather than accruing simply, the actual gap in cost over a long deferral period is larger than a simple percentage comparison suggests. If you're planning to defer taxes for many years into the future, it's worth actually running the numbers, or asking a financial advisor to run them for you rather than eyeballing it. The fourth mistake is forgetting about the equity requirements. Some longtime participants haven't checked their equity position in years. If your home's assessed value hasn't grown as quickly as your accumulated deferred balance and any other charges against the property, you could find yourself closer to the 25% equity floor than you'd expect, which could eventually put your continued eligibility at risk. The fifth mistake is treating this as a federal benefit issue. This program has nothing to do with your CPP, OAS, or GIS eligibility or payment amounts. It's a completely separate provincial program. Don't let confusion here distract you from staying on top of your actual federal benefit applications and renewals, which follow entirely different rules and deadlines. And the sixth mistake may be the most important one, assuming this decision doesn't need to be revisited. Deferring taxes isn't a one-time choice you make and then forget about forever. It's an annual decision. Just because it made sense to defer last year doesn't automatically mean it's still the right call under the new rate this year, and just because you're leaning toward not deferring this year doesn't mean that will still be true next year if your income or expenses change. So what should you actually do with all of this information? Let's make it concrete. First, log into your eTax BC account or call 1-888-355-2700 to check your current deferral status. Find out exactly how much of your existing balance falls under the old rate versus how much, if any, has already been deferred under the new rate for 2026. Second, if you're enrolled in automatic renewal, take the time to actually understand what that means for you going forward. You don't need to cancel it if deferring still makes sense for your situation, but you should be making that choice consciously, year to year, rather than letting it happen passively. Third, sit down and estimate the long-term cost. If you know roughly how much you tend to defer each year, and you know the current effective rate under the new compounding formula, you can get a reasonably clear picture of what a 5, 10, or 15-year deferral pattern might cost your estate down the line. If math like this isn't something you're comfortable doing yourself, this is a very reasonable thing to bring to a financial advisor, an accountant, or even a trusted family member who's good with numbers. Fourth, check your equity position. Contact BC Assessment or review your most recent assessment notice and compare that to your outstanding mortgage, any lines of credit, and your total deferred tax balance. Make sure you're comfortably within the 25% equity requirement for the regular program or 15% for the Families with Children program, so you're not caught off guard by an eligibility issue down the road. Fifth, if you have a mortgage or line of credit, reach out to your lender to confirm that continuing to participate in the deferment program under the new terms doesn't create any conflict with your existing loan agreement. Sixth, if you're on the fence about whether continued deferral still makes financial sense for you personally, consider reaching out to the BC Seniors Advocates Office. They've been actively monitoring this issue, publishing updates, and generally acting as an independent voice for older homeowners navigating exactly this kind of change. And seventh, mark your calendar for the application window every year, May 1st through December 31st, so you're never scrambling at the last minute and you always have enough time to make a deliberate, informed choice rather than a rushed one. There's another important detail many seniors overlook, and it's worth mentioning here as we head toward the end of this video. None of this is a reason to panic or assume the program is no longer worth using. For many BC seniors, especially those with more modest incomes, deferring property taxes, even at the new rate, will likely still be a far better option than the alternative of straining a fixed income to pay the full bill every single year. The goal here isn't to scare you away from the program, it's to make sure you're using it with your eyes open. Let's bring this all together. British Columbia's property tax deferment program changed in a real confirmed way as part of the 2026 provincial budget. Starting with taxes deferred for the 2026 tax year and onward, interest is now calculated at prime plus 2% compounded monthly instead of the old prime minus 2% simple interest. That's a meaningful shift both in the headline rate and in how that interest accumulates over time. If you have property taxes already deferred from 2025 or earlier, that specific balance is grandfathered and stays under the old lower rate. New deferrals from 2026 forward fall under the new rules. The opt-out deadline for the 2026 tax year specifically was June 1st, 2026, and if you missed it while enrolled in automatic renewal, your 2026 deferral is likely already under the new terms, but every future year remains a fresh decision you get to make. The government's stated goal was fairness, discouraging wealthier homeowners from using an ultra-cheap rate as an investment strategy. Seniors advocates have pushed back, pointing to data showing the program is overwhelmingly used by lower and middle-income homeowners, and questioning whether the change functions more as a revenue measure. Both of those perspectives are part of the public record, and it's worth understanding both sides as this debate continues to play out. The program still offers real value. It still lets eligible homeowners stay in their homes without the immediate strain of a full property tax bill. But the long-term cost of deferring has gone up, and the way that cost builds, through compounding rather than simple interest, means it's more important than ever to actually run the numbers for your specific situation, check your equity position regularly, and treat this as an active, ongoing decision rather than something you set once and forget. If you take one thing away from this video, let it be this. Don't assume your deferral situation today is the same as it was last year, and don't let automatic renewal make an important financial decision for you without your input. A few minutes checking your eTax BC account or calling the province directly could save your estate a meaningful amount of money over the years ahead. We'll continue tracking updates on this program along with everything else affecting Canadian seniors, retirees, and CPP, OAS, and GIS recipients, because staying informed is genuinely one of the most powerful tools you have when it comes to protecting your retirement finances. If this video helped clarify things for you, please consider subscribing and turning on notifications so the next update on this program or on any other benefit that matters to you reaches you as soon as it's available. Thank you for watching, take care of yourselves, and we'll see you in the next one.